Welcome back to our channel, where we simplify complex topics and make them easy to understand. Today, we have an exciting video for you as we delve into the basics of the Indian stock market. We'll provide you with a detailed and comprehensive overview, ensuring that even a 16-year-old can grasp the concepts. So, let's dive right in. The Indian stock market is a dynamic platform where stocks are bought and sold, and it plays a vital role in the country's economy. But before we explore the intricacies of the market, let's start with the fundamental concept of stocks. Stocks, also known as shares or equities, represent ownership in a company. When you buy stocks of a particular company, you become a shareholder or part owner of that company. As a shareholder, you have the potential to earn money in two ways: through stock price appreciation and through dividends. The stock market serves as a centralized marketplace where buyers and sellers come together to trade stocks. In India, we have two major stock exchanges, the National Stock Exchange, NSE, and the Bombay Stock Exchange, BSE. These exchanges provide a platform for investors to buy and sell stocks, facilitating price discovery and liquidity in the market. It's important to note that stock prices are influenced by various factors, including the company's financial performance, industry trends, economic conditions, and investor sentiment. Now, let's discuss how one can participate in the stock market. As a 16-year-old, it's important to note that you may need an adult's help to open a Demat and trading account, which are required for stock market transactions. A Demat account holds your stocks in electronic form, while a trading account allows you to place buy and sell orders. Once you have these accounts, you can start investing in stocks. When it comes to investing in stocks, it's crucial to do your research. Start by understanding the basics of fundamental analysis, which involves evaluating a company's financial health, business model, competitive advantage, and growth prospects. You can find valuable information about companies in financial newspapers, online news portals, and the official websites of the companies you are interested in. One essential concept to grasp is diversification. Instead of investing all your money in just one company, it's wise to spread your investments across different companies and sectors. This reduces the risk of losing all your money if one company or industry performs poorly. By diversifying your portfolio, you can potentially mitigate risk and optimize your returns. Now, let's shed light on some key terms you'll often come across in the stock market. The first term is stock market index. An index represents the overall performance of a group of stocks. In India, we have popular indices like the Nifty 50 and the Sensex. The Nifty 50 consists of the 50 largest and most actively traded stocks on the NSE, while the Sensex represents the 30 largest and most liquid stocks on the BSE. These indices serve as benchmarks, providing insights into the overall market sentiment and performance. Another important term to understand is stock market volatility. Volatility refers to the rapid and significant price changes in stocks. It's important to note that the stock market can be volatile, with prices fluctuating based on various factors such as economic news, company earnings announcements, geopolitical events, and investor sentiment. Volatility presents both risks and opportunities for investors. While it can lead to short-term fluctuations, it's crucial to maintain a long-term perspective when investing in stocks. As a young investor, it's crucial to have a long-term perspective. The stock market can experience ups and downs in the short term, but historically, it has shown an upward trend in the long run. Investing in quality stocks with strong fundamentals and holding them for the long term can potentially yield favorable returns. Patience and discipline are key when it comes to investing in stocks. Lastly, let's talk about risk and reward. Investing in the stock market involves risks, as there's no guarantee of returns. Prices can go up or down, and you may incur losses. However, with careful research, diversification, and a long-term investment horizon, you can potentially earn significant rewards and grow your wealth over time. It's important to develop a risk management strategy and set realistic expectations while investing in stocks. And there you have it, a detailed and informative overview of the basics of the Indian stock market. Remember, investing in stocks requires knowledge, research, and patience. Start small, learn from your experiences, and gradually increase your investments as you gain more confidence. Thank you for watching. If you found this video helpful, don't forget to give it a thumbs up and subscribe to our channel for more informative content. If you have any questions or topics you'd like us to cover in future videos, please leave them in the comments below. Until next time, happy investing!